Starting late, our executive ran a little later than expected. We're calling this meeting to order. I note that some of our participants are on a video conference. Today's public meetings are also being live streamed from the Port Authority website. We will now hold a public committee meeting, starting with the Committee on Finance, which will be chaired by Commissioner Cohen, and that'll be followed by the Committee on Capital Planning, Execution, and Asset Management, which I will chair, and then we'll conclude with a public board meeting. Commissioner Cohen.
Thank you very much, Mr. Chairman. Today's meeting of the Committee on Finance is being held in public session in its entirety. At this point, I ask the Secretary to advise those present of the composition of the Committee on Finance and any commissioner recusals on the matters before the committee at today's meeting.
Thank you. Committee on Finance is composed of Commissioner Cohen, the committee chair, Commissioner McCabe, the committee vice chair, and Commissioners Kelly, LaBarbera, and Richardson. All committee members are present today, with Commissioner LaBarbera remote. In addition, also present are Chairman O'Toole, Commissioners Bolwage, Eve, Fisher, Helmy, and Rosado, with Commissioner Fisher and Rosado remote. With respect to the year-end 2023 financial results, there is no action and therefore no recusal required.
Thank you very much. I now have the pleasure to probably do the only thing of significance I will do all week, which is to call on our Chief Financial Officer, Libby McCarthy, to present the 2023 financial performance results. Libby?
Thank you, Commissioner. And good afternoon, Commissioners. I'm happy to present today our year-end financial results. Oh, they're over there. Okay, so I'm going to start with my normal caveats. These audited condensed financial information should be read in conjunction with the financial statements and their related notes and management and discussion and analysis, which will be available today on our website. In addition, I just want to point out that as I'm going through the information that I'm presenting today, it is being presented to you on the basis of the Port Authority's bond resolution, which is the basis on which we set our budget and report to you on our budget. This basis of reporting is included within the 2023 audited financial statements, and there is a reconciliation from this basis of accounting to the generally accepted accounting principle basis of accounting. So, starting out, overall, we had very strong performance in 2023. As you can see here, circled in yellow, the net operating revenues of the Port Authority before consideration of retirement and retiree health benefits costs were almost $300 million, or 10% higher than the amounts we achieved in 2022. I isolate that actuarial pension and other retiree health benefit costs because it's a very volatile cost, which under generally accepted accounting principles, we're required to recognize over a very short period of time changes in the market value of the underlying investment portfolio or changes in actuarial assumptions that may change the overall liability of the Port Authority. It doesn't necessarily change our annual contributions to the retiree benefits, but it changes this book accounting. So you can see here that retiree retirement and retiree health benefit costs increased almost 100% from 2022 levels, or $300 million. So once we factor that into the results, net operating revenues in 2023 were essentially flat to 2022. Two other things, I'm going to give a little more detail on both the operating revenues and expenses, but before I leave this page, two other things I would point out is 2023 benefited from a catch-up in our ability to apply the passenger facility charges that we collect at our airports to expenditures on our airports. You can see 2022 is a low number, and we were able to catch up as we work through eligibility with the FAA on certain of our expenditures. And then the final thing is that our investment portfolio had a change in its market value due to changes in interest rate, which is a swing of $265 million as compared to last year. And that's also reflected in our results. So at the net revenues available for debt service line, our results were up by $600 million, which is a positive. So as we normally do, I'll just talk a little bit about our activity levels at our facility, which drives a fair amount of our revenues, and then we'll talk about our revenues overall. So this chart, just to orient you, has tunnels, bridges, and terminals on the left and aviation on the right. These are, of course, our two largest revenue producers. The gray bar is 2019, just as a point of reference, as we still look at how we've been recovering from COVID-19. Blue, 2022, and the green, 2023. TB&T, you can see our activity volume was up 2% versus 2022 and was ahead of the 2019 levels. That was driven partially by some milder weather we had in the first part of 23, but also as a result of just the economic conditions in the region. Aviation, which had a strong, was working its way back from sort of its very low in COVID, had a very strong recovery and further recovery in 23, 12% increase, and it actually reached and surpassed the 2019 levels. So it's setting new records again as we look at our aviation activity. This is what we're seeing is that there was very strong demand growth in the domestic side, and that is still offsetting the slightly lower than 2019 levels of the international activity. So we are sitting right now at 103% of the pre-COVID levels at our airports. Moving on to PATH and our ports. The PATH system, which is on the left, here you can see it had very strong growth in 23 versus 2022, 19%, but we're still well below the 2019 levels, sitting at about 61% of 2019 levels. We're expecting that PATH system to recover at a slower pace. This is really driven by the return to the workplace environment and potentially the hybrid work model that's being adopted by many employers in the area. On the port side, we had versus 2022, we are down from the record levels that we were setting in 2022 due to macroeconomic effects with respect to supply chain and the still strong goods-driven economy. But we are up versus 2019 levels, 3% over the 2019 levels, and the ports are continuing to be very strong in that they are still the largest ports on the East Coast and the number 2 ports in the country. So that while there's that downtick, it's still very strong recovery, and it's driven by the macroeconomic environment that we're currently in. So now moving on to gross operating revenues. Here you can see that gross operating revenues for the year are up about 10%, $600 million from the 2022 levels. And we've got it broken down for you by the types of the various components. So biggest drivers here are on the rentals and aviation fee perspective. So on the rental side, up $200 million. That's driven by the full year impacts of some of the terminal developments that have gone into effect, as well as the new Terminal A at Newark. On the aviation fee, and then just regular standard escalations, plus some activity, the higher activity levels at JFK Terminal 4. On the aviation fee perspective, that's comprised of both our cost recovery plus the activity-driven access fees and the airtrain fees. That's up another healthy $200 million. And then the remainder is really driven by the tolls and fares, somewhat the activity I just described, and then as well on the toll side, we had a toll increase that was effective at the beginning of last year. Moving to operating expenses, here I mentioned to you the impact on the retirement and retiree health expense. So the expense was up $600 million or 18% from 2022, but over half of that is driven by that retirement benefit costs. If I strip that out of the employee compensation numbers here, the increase in employee compensation was 2.9%, or just really driven by wage increases and workforce and work balance. On the contract side, we are up, and that's driven by some of the increased maintenance at our facilities for some of our assets, critical assets, and then as well just the higher activity level requiring us to ramp up our spending in response. Moving on to our cash flow and liquidity. Again, very strong position here. Cash flow from operations increased by 4% versus 2022, and we have a very strong liquidity position. Cash and investments at the end of the year were $5.4 billion. Our days cash on hand was 280 days, and our revolving credit facility had another $230 million available to help us fund our capital plan. And finally, on the debt side, our debt position actually decreased at the end of the year as compared to the beginning of the year. That's a result of our retirements and refundings exceeding our new debt issuance. Partially, that was dealing with the consolidated note, the short-term note that we took out in the post-COVID environment to work our way through that, which we retired and refunded, partially using some cash on hand as well as some issuance of that on a longer-term basis. And so those are our financial results, and I'd be happy to take any questions.
For a usually concise and excellent presentation, and have a good week. Turn it back to you, Mr. Chairman.
Thank you, Commissioner. And we have gone over that many times with your leadership, Commissioner Cohen, week in, week out, month in, month out. So that's a great summary of what's gone on for the last series of months.